Welcome to this week's Real Estate Weekly Deal Breakdown. Today, I'm actually talking about another rental property that I bought that is in my hometown, actually my home village of Monroe, New York. And I'm going to tell you how I bought this thing for a really good price and why, on the surface, this was not a home run deal, but after a few years, turns out this was a good one. If you have not seen any of my material, my name is Greg, and I've been an investor now for over 10 years. I've done over 500 properties at this point, so I got a lot of experience. If you get value from this, do me a favor. If you're watching it on YouTube, if you could subscribe to my channel and like the video if you haven't already done so, that would be awesome. And if you're listening to this on a podcast platform, if you can share this podcast with somebody who you think would get value from it, that would mean a lot to me. That's how we continue to grow the show on a weekly basis, which is awesome to see. So let's get into the meat and potatoes on this one. This is a condo that I bought in Monroe, New York, 10950. This is in the village of Monroe too, so it's in an absolute premium location. I got the lead. It was from text messaging. So this was back, we don't even do this anymore, but it was cold text messaging. Somebody responded. They were like, yeah, I want to sell. There's a tenant in there. And I looked at the address. This was, like I said, a couple of years ago. And I was like, wow, this is a good location. This is a really good spot. I know exactly where this is. I think back in the day in high school, I might have applied to be the lifeguard in this community. So I was like, I gotta find a way to buy this property. So anyway, we ended up going back and forth. They wanted to sell it as is, and they wanted to sell it with the tenant inside. And this is right when I started buying rentals. This might have been a year and a half after I bought my first rental. So I was now kind of hot and heavy, looking for more of these. So I think he said he wanted 125,000 or 120. He said he wanted a good price right off the bat, and I didn't want to try to get cute with the guy because he was pretty savvy. And I remember telling him, I said, listen, I'll buy this thing as is. I'll buy it sight unseen, and I will buy it with the tenant inside. And that's all good because in my head, I knew it was worth more than what I was paying, and I knew the location, and I'm like, this is a good asset to have. So anyway, the way that I funded the deal on the original purchase is I called up my private lender, who ironically lives about 700 yards away from this property. So this was a local deal with a local lender. I got a loan actually for the entire purchase price on this, which was cool. So I was only out of pocket the closing costs, and then I owed the guy, whatever the interest rate was on a balloon payment. So I had no monthly payments, and I'm like, okay, we're good. So I end up buying the property, close on it. Guy funds the deal, the lender, everything's good. I own the property now. So I knew that now in the future, two things have to happen. I need to refinance this property, and I need to, get in touch with the tenant to just kind of see what their plans are, what they're doing. And turns out that she was paying well under market rent, which at the time was like $1,000, or it might have been like $1,200. It was super cheap for living in Monroe. I told her I'm not going to raise the rent right away, but eventually I'm going to have to raise the rent. And she knew that. She was cool. I treated her with respect. I was transparent. I, gave her all the options. And turns out that there was a program that was actually willing to pay all of her rent. So that was a bonus to this situation. And now at that point, I knew, I'm like, okay, we got good rents. We got more revenue coming in the future. So I said, I got to go refinance this property. And now at this time, this is where the market started shifting. The interest rates started going up. And this is in the latter part of 2022 because the rates were in the sixes at this point. So I ended up calling up my credit union, once again, local bank. And I like this credit union because they do 15-year mortgages for rental real estate, which is higher on a monthly payment standpoint, but better because they get paid off in half the time. So I got a loan on the refi for exactly what the purchase was. So I was out of pocket on the interest I owed to the lender. I was out of pocket the closing costs on the purchase, right? Because there's closing costs when you buy. And I was also out of pocket on the closing costs on the refi. So I was really only out of pocket on both of the closing costs and then the lender's interest. So I think on this property, I'd have to go back and look. I'm probably out of pocket $30,000 on this max. And the bank said, okay, we're down to do that. We're going to pay off your private lender loan with the interest. This is what you're going to be out of pocket. They sent me the closing statement. Everything looked good. We ended up closing the refinance loan. Now my private lender got paid back his interest. He was happy. Now I got, permanent financing on this property with a local credit union. And right from day one, the property basically broke even, which was awesome because that program that the tenant was on, they started paying the rent. So now I knew I could, raise the rent and it wasn't even coming out of her pocket. So rose the rent basically up to a break-even situation. And I just wrote it out. just rode out the property. Every year I've owned it, I've bumped the rent up reasonably, right? Reasonably to adjust for the increased HOA, the increased taxes, the increased insurance. I think to this day, this property maybe makes in net cash flow $150 a month, best case. And yes, I've had to do some work to the property over the years. I've had to, replace things and, have, contractors go over there and fix stuff. And that's all part of being a landlord. If you're not down to do that, you shouldn't own rental properties. So at the end of the day, this is a great rental. It's in a great area. I've been paying down the mortgage on the thing now for basically 3 years. And here's the good news. Here's the good news. Because of where the property is and because of the location and because of the demand, it's worth about $300,000 right now, which is insane to think that. And I paid 120, I think it was 120 or 125,000 for it. And now I probably owe on this thing now maybe 105,000. Actually, I can tell you what I owe on this thing right now. I'll tell you exactly what I owe on this thing. It's worth $299. I owe 103. This property has $196,000 of equity over time. Now, how did that equity show up? It didn't just show up like a genie in a bottle. It showed up by buying it right on day one. And then since then, the market's gone up in the Northeast. Inventory has been scarce and supply and demand has dictated prices to go up consistently. Now it's worth basically $300,000 and there is almost $200K of equity. Now, if I were to sell it, yes, I'd have to pay commissions. I'd have to pay closing costs. I'd have to recapture my depreciation. So I wouldn't net $200,000. And anyone who says they would is bullshitting. But this thing went up $200,000 or it's worth $200,000 more than what I owe. So this is the type of rental that you want to keep on your balance sheet because over time, you're going to make payments on the property. The property value most likely is going to continue to reasonably go up. I don't expect this thing to triple anytime soon, but this is an asset that is for your balance sheet. This produces income. It pays for itself. It makes a little bit of cash flow that we can use to reinvest back into the property. And it's got a $200,000 padding of equity. And it's in an A-plus location in the village of Monroe, right, where there is high demand and low supply. And this is the type of rental properties that I like to keep. I like to keep local properties that I'm extremely familiar with. And this is a property that's always going to be in demand for rental and eventually resale. But I really plan to keep this thing because it's a great asset. So what are the takeaways from this? What are the takeaways from this property? You've seen a few of my breakdowns on my rentals. I'm a big fan of not owning tons and tons and tons of rentals. I'm a big fan of owning maybe less rentals in better locations with great equity positions. Because once you have all that equity stacked up in your portfolio, you can then at that point, if you want, trade that equity for bigger and better deals if you do so choose. And if you don't, now you're sitting on a lot of equity and you're in locations that are premium where there's good rent, there's high demand, and there's a good economy. So you need to keep, in my opinion, rentals in areas that you really believe in. And I believe in the lower Hudson Valley. I believe in Washington State, even though I don't have any rentals out here. It's a good area for rentals. So the takeaway on this one is that buy local and buy where you know the value will go up over time. Now, I knew this thing day one was a good deal, right? And I didn't really think it'd be worth 300 grand, which it ultimately is now. But that's icing on the cake, and that's the beauty of holding on to rental real estate, right? The thing that drives me the craziest is when people don't keep any properties because they say they don't want to manage their rentals. It's worth it, right? Your properties are going to go up in value, most likely. You're going to pay down your loans. You're going to have cash flow, most likely. You might not retire on that cash flow, but you're going to have cash flow. This is what the game is about. Now, the thing I want to tell you about this, I bought a property down the road, okay? No kidding, for $160,000 in 2000 and I think it was 2020 I bought it. And this was when COVID was going on and no one knew what was happening. Did a renovation. It was a $90K rehab. The thing looked like it was new construction. I sold the property at the time for $375,000, which was absolute top of the market, like sick price. No one could believe I got that number for it. I made almost $100,000. I made about $90,000 in net profit on that flip. That was a great deal. That same property today, the one that I flipped, is now worth $550,000. My cost basis on that property, if I were to keep that one, I should have kept that one, but that's baseball sometimes. 160 plus 90. The rehab on that was big. It was like 90,000. So I would have been in for 250 plus, let's say, another 25 in soft costs. I would have been in that property for 275 all in. And I would have refinanced and I would have probably owed at that point 225 on a property worth 550. And that thing would have rented all day, every day for $300 to $3,200 a month. And that thing would have made $700 a month of cash flow, and it would have had $250,000 of equity. So that's why you need to understand. And I should have kept that property. I did not. I flipped that property. I was grateful I made almost $100,000, but I should have kept that property too. So the thing I'm trying to get at here is that when you get home run deals, it is tempting to flip them. And trust me, been there, done that. You need to have the foresight to keep some of those properties for yourself, because that is how you get wealthy in real estate investing, is by what you own, not what you do. Hopefully you got some value from this. This was a good condo. I'm grateful I own it. If you are in the Hudson Valley, or you're in the Seattle area, or you're in the state of Delaware and you have a house you want to wholesale to me or wholesale with me, we just got a JV deal from somebody out in Tacoma yesterday, actually. We'd love to do more deals with you. Like I said, I'll buy it as a direct buyer if you want, or if you want to wholesale with me, we can do that on a JV basis. Send me an email, greg@velocityhousebuyers.com, or a DM on Instagram @grego_37, and I'll see you on the next real estate deal breakdown. Take care.